commercial real estate and specifically multifamily?
Sure, yeah. So I started brokering for a small boutique firm, the Cantrell Company, back in 2000. They specialized again in multifamily, kind of B and C class throughout Dallas, Fort Worth. Had a good run there of about 14 years, but knew I wanted to go out and do my own thing, probably a couple years, 2, 3 years before I even left. And so I did. And, my first venture out in January of 2014, we joined the SVN platform, was formerly known as Sperry Van Ness. And we had a good run there as well. We're one of the top 3 offices out of that network nationwide in terms of production. And, myself, I finished, in the top 10. I think virtually every year we were a member of that network. So after that, we came to the end of our 5-year agreement, and we could either renew or figure out another route. Well, we always wanted to bring on the debt platform. There seemed to be a obvious synergy there. And great. So, several firms either approached us or, we reached out to them. And just before we had to make a decision, a gentleman named Jim McDevitt came along and offered out, service that Greystone had started, is to join them as a joint venture partner. And it sounded like a neat deal. It brought on, the debt platform so we could direct our clients and give them, a bit of service in terms of, hey, we'll provide somewhat of the capital stack and, provide the investment sales, the debt. And, the ultimate goal moving forward is to also, get an equity platform going to. So that's going to be my focus in the immediate future, I'd say, of the next 2-3 years. So just, continue to grow at a good pace. Yeah, like I said, just been doing it for about, going on 22 years now of just multifamily brokerage, generally B and C class. We have formed an institutional division within the Greystone Dallas office. And, that's coming along well. It is something that takes a little bit of time to form, but we have several 2000s in newer construction properties currently that we're out to market with, and several more in the pipeline.
Yeah, that's great to hear. We certainly can say that you are, when it comes to multifamily in the Dallas market, that you are one of the expert leaders in that field, right? You have gone through the cycle, so you know how it looked like, and then you had over the last 10 years or so, you had that great run up, and for a while it looked like a pretty scary March of 2020 when COVID-19 and the lockdowns all hit us at the same time, right? Yeah. And it looked pretty scary for all asset classes, including multifamily. And us, John and I, on the debt side, we certainly have seen all the lenders pulling out other than the agencies. So that was very scary. And I'm pretty sure you had a lot of concerns then too. And now we are a year and a half later, and we are completely on fire in that market, right? So how have you weathered that storm, and how have you approached your dealing with your clients during that period, and where do we stand now today with all that?
Great question. Or questions, I guess I should say. I'll try to touch on them all. So had previously gone through the Great Recession, a down cycle. When I came into the market, we were really coming out of the .com bust as well. So that was, caught part of that cycle. and things coming up out of that were exciting. You get to ride that wave, is what we like to say. So you know when the pandemic hit, and like you said, second quarter was just very slow. Having to reflect back on my experience of the Great Recession, I was like, what can we do to be of service to our clients? That's the most important. When you're just not transacting, we don't take off to, Miami for, a year and hang out on the beach. That's not going to get much done. It is an opportunity. It was very busy before then. So it was an opportunity, one, to focus on the business, see where we had any inefficiencies in terms of, expenses we weren't managing right. It did allow us to take some time to audit the books, focus on efficiencies for the business. That was exciting. Saved a lot of money on client entertainment during that period of time, I will say. So that was, somewhat of an unexpected positive. But more than anything, what we did that was very effective is we just shared a lot of information. We did not stop calling our clients, and that was one of the directives. And hey, what are you seeing in the market? What are you doing? And just sharing information from all over the market. We did a great job of it here in the Dallas office as well as the national platform. So during that time when everyone was locked down in their home, we still made it a point. We always have a Monday morning, production meeting, but we also had a Zoom lunch together 3 days a week. And we would all share stories and everything that we were hearing and, what's going on around the country. And then after you had that lunch and you shared that story, you could then go and call your clients and, share all the information that was being shared with you. So everyone can kind of get a grip on what's going on in an unstable market, because that's the way you can be most valuable. When there's not stability, information is very, very powerful, and it's powerful at any time, but especially during a time like that. So a couple of things that happened is, everyone was pulling their properties off the market that we had just listed, because it was just, the perception was, hey, you're going to have to sell it for a discount. Fortunately, I had a client that, said, hey, I told you when I turned 75, I'm selling this thing. And, let's just go forward with it and see what happens. And I said, yeah, I think that's a great idea, because, even if it doesn't sell and we don't achieve your objective, we can certainly say, hey, that was COVID, it didn't work out, and wait and bring it to market, maybe a year later when things, or whenever that time period is, when things get better. So one thing we discovered through that was there was still demand for buying apartments, but there was no supply on the market. I mean, literally none. That apartment complex was the second one to hit the market after everything shut down during COVID. So we had after that was going extremely well. We had lots of tours, lots of interest. We ultimately sold it for above list price with, a lot of non-refundable earnest money the same day to a very qualified buyer. We brought, I can't remember exactly, I think it was between 15 and 18 offers on it in the middle of a pandemic. So we're like, hey, the message changed at that point of like, look, this is a good time to sell your property because there's very little competition on the market. There is no supply. You have an opportunity to bring your property to the market when there's no supply. Interest rates are going to an historic low. And, what people are underwriting right now is pretty flat. Once we got past, I'd say, about June, and everyone saw that, hey, rents aren't going away. People are still paying rent. This doesn't seem to be a problem. That increased investors' confidence that everything, was either going to be the same or increasing for the rest of the year. And then, hopefully as this passes, I think everyone thought like, hey, the pandemic's going to be over in the fall. Obviously it didn't go that well, but people were projecting like, hey, after that, we'll be able to increase rents. So we had another property on the market, same deal. We achieved over list price, and that convinced that particular ownership group not to pull their property off the market. And we were able to go forward with both, and it was successful. And At the end of the year, we ended up having a record year over the prior year by 20% over our production of the previous year. So, by not slowing down and sharing information, it really paid off in the end.
Yep, that's great to hear. I think certainly in the multifamily space, we had the advantage that financing was still available, right? In some of the other asset classes like hospitality and retail in particular, virtually none of the financing sources were even available. On the multifamily side, it was still pretty tough, right? As you probably recall, bridge lenders, a lot of them moved out. CMBS lenders shut it down for
Yep.
For several months. But we had the agencies, right? And they were the saving grace to keep that confidence going. And then once everyone saw, hey, we have actually still the rents, as you just mentioned, the people still pay rents, then everyone realized, I think this is the asset class to be in.
Yes. And, like you said, we always had the agencies, or we have always had the agencies to kind of bail us out during any sort of downturn, and interest rates go lower, and that always helps. But where we are today is amazing versus this time last year, if you think about it, because I mean, I don't know about what you all are experiencing. I'd be curious if you would tell me, but we're finding 85% of our transactions are bridge debt. So we're just not doing, near the volume of agency that we anticipated that we would do this year. And talking to our other offices around the nation, they're experiencing the exact same thing, even in like Detroit. So, you take two very extreme different markets, but bridge debt seems to be, the favored, debt right now. Is that what
Yeah,
you're saying?
that's definitely the case. I would say in the multifamily, it's only 80% plus, right? Over the last 6 months, we have seen even for stabilized properties. It's just that there is so much of a demand for these assets. If anyone wants to have a leverage that is above 65 or 70% in some of the top markets, that's where you end up, right? So it's just the reality. There are some, obviously, mostly family offices and institutionals, and then private individuals that are fine with lower leverage, but it's only a large number of investors, whether you're syndicators or funds. They need to work with a leverage that is at that 70% plus. And right now, bridge loans are really the only viable option in most instances.
Yeah. And, everyone has a business plan. There's value add is, been popular for a very long time now. I've gone back and looked at underwritings that I did way back in 2000, 2002 range, and I didn't remember it this way, but I did see the statement value add many times throughout my proposal of hey, what can you do to add value to the apartments? It's always been there, and if you think about any business that you're selling, hey, what inefficiencies are there that I can come in and fix and increase the value of that business. But that with bridge debt, I just think, what happened is obviously a lot of people achieved their business plans sooner than anticipated and had these huge prepayment penalties. And, they planned on holding for 5 to 10 years, and, they achieved their business plan in 3, and they got a, $1+ million prepayment penalty that they don't necessarily want to digest. So I hope it's not an overcorrection into bridge. That's one thing that kind of concerns me of, how much bridge debt is getting done, and, when that comes due, what do interest rates look like on the agencies, or, on the permanent loans when those are takeouts. So that's something that we're watching here. Is if people get over their skis a little bit with these business plans. But I mean, the fundamentals are still really good for it. It's just a concern that there's so much of it, but there's nothing on the horizon that would, make me think that you wouldn't be able to achieve your business plan. I mean, rents are going up, as you all know, about 10% in Dallas, Fort Worth, year to date. So, we anticipate we'll be, well above 10% by the time year end rolls around. In areas like Collin County, we're seeing 20% rent increases. So, that's the overall average is 10. There are certain, more attractive markets that are doubling that and more. So it's exciting to see, we still have the in-migration going on here from all over the country and outside of it. We, slowed down on the number of units that we're adding to the pipeline. So I think that will, also help, keep rents trending the right way. Again, it's just supply and demand. We have more demand for apartments than we're supplying right now. As long as that continues, I believe, we'll all be okay.
So Todd, a quick question. You just a little bit previously mentioned, going to market last year with a couple of properties, a little bit surprised with the overall demand. My question I'd have is maybe, what about the quality of the buyer and the packages that you were getting? Just how well qualified folks were. Is there any kind of material change as far as folks that are putting in LOIs, a year ago versus today, and how do you think that's impacting, what sellers are thinking about as far as bringing a property to market or not?
Yeah, so we always need to qualify our buyers, especially amongst properties that we are listing and going through the full call for offers process. First round, second round, sometimes third round. The difference is not great between what they were last year and now, but what the difference is there is so much supply in the market now. It's much like the rest of the economy where you had this pause and the supply chain was broken. It seems to be like multifamily's almost advanced beyond that. When everyone, it's the sudden stop start that kind of messed things up in this pandemic, and it's true for sales as well. There's a lot of product on the market right now. So as brokers, what we're having to do is spend more time on the phone with these qualified buyers and keeping them focused on the opportunity, because there are so many shiny objects in their periphery that you can easily lose their attention, and they're like, hey, we're going to go over and we're going to work on this one. We don't want to wait 2 to 3 weeks for the call to offers. I've got an opportunity right now. I'm pulling out of this opportunity. And so it takes a lot more follow-up. Whereas last year, like I said, it was between 15 and 18 offers on that asset. I bet if I brought it to market now this year, it would probably be approximately half of that, the number of offers. Again, we're going to vet the offers. So they're going to be, there'll always be some tire kickers mixed in there. But I would say, you'll have half the number of qualified buyers today bidding on an asset than you had last year. We're still achieving the list price. Our average right now, we're averaging 101.4% of list to sell ratio. So we're definitely still hitting our numbers, but it's more challenging than it was this time last year.
That's an interesting point. Obviously, last year was really unique, right? Where everyone was putting everything on hold, and you mentioned the supply chain in different industries, and it's true in multifamily. It was kind of similar. Everyone put a stop on their supply because they wanted to see what was going to happen, and that was only beneficial for the ones that were willing to put their properties out there. When have you seen kind of that shift from where we were a year ago to where we are today, where now you have to work much harder to get the attention from your prospective buyers? Was that a couple of months ago, or is it 6 months ago, or when do you?
I'd say between 3 and 5 months. It seemed to happen kind of beginning of summer-ish. We started noticing this of like, wow, why aren't we getting as many offers and as many tours as we were having previously? And you always self-analyze, and we have the meetings, and
Sure.
how many offers are you getting, and we didn't know if it was something we were doing wrong or what was, and we just we're friendly with many of our competitors, and we
Sure.
talk, and they were experiencing the same thing. So it was a bit of a relief that it wasn't us, but at the same time, it is just a reality that we have to work with, and it will. I think what else accelerated the sales for this year that I feel like there could be a trend back to a normal supply next year is the pending tax hikes.
Sure.
That motivated a lot of owners that are in their sunset years to say, hey, I might not live to see another cycle, so I'm going to go ahead and just exit now and pay the lowest capital gains tax rate that I'll probably ever see in my lifetime and move on. So we do have a handful of those as well. So I think kind of it's not a perfect storm, but a couple of things came together to really increase the amount of supply on the market. And I think a good scare always gets everyone to sell.
Sure.
Like if you almost just fell off the edge of the cliff, but you pulled back, and hey, it's your investments are still worth what they were prior to that scary incident, or maybe even more afterwards. You're like, I am gambling over here on some level. So I better go ahead and cash in my chips, because I've already won. And what am I doing here really by how much more am I going to win if I hang on?
Yeah, that's an excellent point. I think when we look at that storm, that perfect storm, we may also have seen it a little bit on the buyer side, right? With everyone obviously knows that we when it comes to bonus depreciation, it will phase out, right? And so there is an incentive to buy properties this year and still next year. So I think that's certainly also what has helped, together with the record low interest rates, where people realized, hey, I think this is now still a good opportunity to jump in. And that was probably initially where a lot of these buyers were jumping on it, and now a lot of them have already covered their bases, so to speak.
Yeah.
But it will be interesting to see how it goes next year, right? Whether it's balancing out, as you were mentioning.
Yeah, we'll see. The crystal ball isn't always 100% clear, but it just depends on what tax changes actually get through, and which ones don't. When we're wrestling with on a personal acquisition, on a development of just developing paper lots, it's a relatively short-term hold. And so we're like, look, it's short-term capital gains versus long-term capital gains. And we're like, it's next year. There might not be a difference. Who cares? We'll just go ahead and we'll do the 6-month turnaround instead of, trying to, string it out over a year to save some tax dollars. And, at the end of the day, I think what a lot of people like, look, there's a lot of different ways you can avoid paying capital gains, whether it be the obvious 1031 exchange, Delaware statutory trust, the opportunity zone fund. You could put it in. There's, tax deferred trusts. There's many vehicles that, you can put the proceeds into, either delay the gain or, just avoid it altogether. So, there'll still be transactions. People will figure it out. I think one thing though, if the 1031 exchange does go away, or they cap it at $500,000 or $1 million or or whatever's being proposed right now, there'll be a bit of a pause in the market. I think, that it constitutes approximately, 10 to 20% of our transactions are 1031. So it's not like a massive number, it's not, oh my gosh, this is going to crater the economy. We'll find alternatives for the 1031 and figure it out. So, but there'll be a pause. Like what I find what's happened through many cycles is, for example, I think you would know, Anton, too. I think you feel this as well. When interest rates like bump up relatively quickly, like, they kind of are right now. I haven't looked at what the 10-year was today, but I know it's 1.61. The last time I looked a day or two ago. And, that went up, 30 basis points in a matter of about 3 weeks or so. That's a relatively, quick increase. We find that when they go up about a point, and where it does impact pricing at some point, where there's just a pause for about 6 months, and transactions really slow, if not stop, for that 6-month period of time. Whatever you had in the pipeline's probably okay, but no one's going to start a new transaction because no one wants to believe the value of their asset just declined due to interest rates going up. And it really takes about 6 months for that to resonate on both sides, buy side, sell side, and then it picks back up again. So that's just, our experience over the years that we've done it. We'll all be okay. The fundamentals are just so good here in Dallas, Fort Worth. People are itching to get in. We haven't seen this sort of activity from East Coast money and buyers in my 21-year career. We've always had the California money coming this way. But now, and we've always had East Coast money coming this way too, but not at this level. There's a lot more interest to come to Texas. I don't know. It's just, so now we've got it coming from both sides instead of one side. So we'll be okay.
Yeah. It's only Dallas and Fort Worth certainly has been put on the map in a much stronger fashion. Obviously, it helps with major headquarters moving to to Dallas and Texas, right? Even if Elon Musk moves to Austin, it still helps the recognition of every market in Texas and all the other companies too, right? So that's definitely beneficial. Within Dallas, do you see any changes in what submarkets buyers are considering more desirable today than a year or 2 years ago or pre-COVID?
Pre-COVID, I don't know that there's a large interest. There hasn't, I feel like, the submarkets have not been impacted, relatively speaking. They all are about as desirable as they were at any given point in time. I have seen, and you and I worked on a transaction, a few years back called El Rancho in the Las Vegas Trail area of Fort Worth. And I know that there are some old school investors that's a no-fly zone for them. Of like, man, that's, that area that's a tough submarket. You're going to struggle over there. And, the gentleman that we sold it to couldn't be happier. They've, done great. They've achieved great things. They've implemented their business plan, and it's been a very successful investment for them. So, that's neat to see. Like, that area just, especially like during the Great Recession, had such, I guess, an undesirable, hue to it that people viewed it back then. It's like, hey, this is an opportunity because, the assets are so affordable over here. And, that I think that has changed. Some of the areas like Woodhaven, Las Vegas Trail, South Dallas, it's just, we say it's very salt and peppery. You could cross a street, you're in a good submarket, or, you on the other side of the street, you're not. So it's just, that's the importance of the boots on the ground, of really knowing what you're doing. I would say like West Dallas has been very desirable. We have found that, around the Bishop Arts area, and, with the new deck park going in over 35, we've seen a lot of desire to get in that submarket. It's kind of getting ahead of it, of like, look, this area is changing a lot. The city's obviously putting a lot of money into it. There's large portions of it that have been marked as opportunity zone. So you have the OZ funds going into those areas too. East Dallas, I swear, every time I drive through it, it changes like you wouldn't believe. There's still the salt and peppery nature of East Dallas as well, but man, it's really trended to, just new construction all over. One of my clients just, they were building like a small, I want to say 12-unit townhome development before they even got it completed. They have it in escrow at $420,000 a unit for new construction over there, whereas the prior year in December, we sold a 2014 construction, I believe it was, for about $360,000 a unit on a 6-unit complex. So, I think that infill area is back. Obviously there was some stigma during COVID to, being in the core, but it's weathered it relatively well.
Yeah, so it doesn't look like Dallas has been that much affected, right, by that stigma. Obviously,
Yeah.
other markets have, but Dallas, it doesn't look that way. Right?
Well, and I've been asked the question many a time, like, well, where are the tenants looking to go? What's more desirable? And I'm like, look, there's not a right answer to that question. They're both. I mean, we do have demographically, people are, getting to be of the age where, yeah, they're going to move out to the burbs. And, if they can't afford a home, they're going to rent a home. The build for rent product has become so popular right now. We're working on a lot of those projects. So, I don't know, the market just kind of, figures it out of like, look, I've said, like, I feel like a home's always been more desirable to rent to most folks. Maybe, if you're single, and straight out of college, or within, 10 years, I should say, of coming out of college. Look, an apartment community is nice. You get to meet more people. I met a lot of my friends when I moved to Dallas that way, and I still have that core group of friends. But like at some point, you always want a little bit more space. You always want a little yard, something like that. So it just seems to be the natural next step in evolving. I said, even through college, you start out in the dorm, and then they let you move to an apartment. And then after the apartment, you get a group of friends together that you met at the apartments, and you rent a house, so you can throw parties with everyone.
Yeah,
And,
that's right. Yeah.
Yeah, it seems to, play out that way in adulthood too. So it's kind of fun.
Yeah,
to see.
yeah, it's an excellent point, right? So we progress through life, right? And when we look back, what was okay for us during the college years, we are wondering how on earth did we live like that? Everyone does.
Yeah. Man, college kids have it a lot better than I had now, I'll tell you. Go see student housing. It's like you get to live in a cruise ship while you're going to college. I mean, ours was like, I think they held together the apartments with gum and duct tape, as far as I could tell.
Yeah, they definitely have changed that, particularly the college supply dorms were not nearly as nice as the the housing that we see now today by third parties that built them, right?
Oh, it's phenomenal. So we live, right now about a mile away from UTD, and my son plays soccer, and so we go, and that's where he practices. And one thing that, if you haven't been on a campus in a while and seen this, they have little cars that are robots going around on the sidewalks, and they're delivering food and supplies and everything, so that you can order stuff that way. Literally, a robot shows up in front of the dorm. You walk downstairs, punch in a little code, take your food or your supplies, and go back to your room. I mean, they're living in the future out there. It's pretty cool to see.
Yeah, definitely. It's it's a different world, right? What our students see today than what we saw. That's definitely the case. Uh, Talking about student housing, you obviously that's not a core activity on your end, right? But have you seen some of your colleagues what how the world looks like there in the Dallas market?
Yeah, well, in Dallas, you know, I mean, it just where the two, I'd say SMU and TCU are located. Those are just really desirable neighborhoods, generally speaking. So I think they're pretty insulated from any sort of recession. The only time actually that you see apartments go for sale in those areas are, when you're at a peak or the peak, when someone really wants to cash in, they're going to hang on during any sort of downturn. But we did see a couple of distressed assets at TCU during the pandemic from a lender. And, kind of the lesson learned there and, talking with all the other student houses, I actually had dinner with a couple of guys out of Tricon, which is a student housing brokerage firm in the Midwest. Went to Chicago a couple of weeks ago and had dinner with them. And they, demographically, student housing it's okay, but you've kind of got to be right on campus or right on the main artery into campus on the bus line. And like kind of the periphery student housing that was getting built where they're stretching a little bit, they are leasing by the bed, but it's like, this is kind of far from campus, and this isn't really like, surrounded by other students. It's starting to feel more like the city than it is the campus. So where student housing can be an extension of campus, I feel like that's still a really good investment, really well insulated. That periphery stuff, I think it's risky. You've got to count on the university growing. And the demographics don't bode well for that right now. The millennials, that was a huge generation. Gen Z does not have the numbers that the millennials do. And, people are questioning the value of that diploma now more than they have in the past as well. And, then through the pandemic, the online schooling and, these sort of Zoom podcast things and stuff that we're even able to do that were not, hugely popular just 2-3 years ago. They've become the social norm. And so I think, that's why some of that periphery stuff, I think you could see some distress in that. And, what we're kind of looking at is that sort of housing that's periphery that have loans coming due, like this year or next. Because generally, the agencies did not finance those. It was either going to be bank debt or CMBS or something like that. And those lenders are not as forgiving as agency. They can be a loan to own type lender versus, a lender that wants to do a workout with you and can understand that, hey, we had a hiccup in the economy. I know your loan's coming due, but let's do a 1-year extension and, or switch to interest only or something like that. Those lenders tend to be more opportunistic. And so, we're kind of monitoring that to see if there would be some distress in that sector.
Yeah, interesting point. It will also be interesting to see where some of the large operators will pick them up, right? The ones that are in that periphery you mentioned, right? So it's obviously not necessarily what they like to own and operate. Question is if the price is right, whether they still would do it or not, and that remains to be seen.
Yeah, I think the price is right when you can underwrite it by the unit, not by the bed.
Yeah,
that periphery stuff, that's the reset there of like, okay, we probably have a bunch of 2, 3, and 4 bedrooms if it's student housing. The design's going to be a little funky compared to a traditional apartment unit. But hey, what is that unit rent for to the general population?
Yeah.
And if it works on that level, like great. They're still pretty desirable areas. They are close to campus, and it could be the alternative of the type of student I was, the blue collar student, that has to work their way through school. I mean, I bartended, waited tables. I was property manager of the apartment complex I lived in, and I went to school full time. So, there are those types of students that are more blue collar like that have to make it work. And, I was happy to live on the periphery and ride my bike an extra mile to save, several $100 a month. That was a lot of money back then.
Mm-hmm. So do you see, based on your discussions, that some market rent prospective owners would be willing to pick up some of those and convert them from the student housing model to a regular multifamily property?
Yeah, more of like a traditional, conventional
Right.
type multifamily. Yes, but the income generally gets cut down on that.
Right.
So,
Sure,
it's,
it does. Yeah.
what's the seller's tolerance for pricing? And, in the example that I gave you with the two properties that were around TCU, the lender was not, we determined it wasn't worth spending a lot of time on. Their pricing expectations,
We're still too high.
Yeah, we wouldn't have been able to achieve them, had you converted this to a traditional multifamily complex.
Yeah, that's a good point. We have seen something very similar in Houston, kind of a property that would be perfect for a conversion, but the price expectation was just still way too high.
Yeah. Is it like a hotel type?
No, it's a student housing property.
Oh, okay.
Yeah, but they are still pricing it as a student housing. And unfortunately, that still doesn't work to convert yet, right? So
have you seen many hotel conversions come across your desk?
Yeah, we have seen a lot of them. The challenge there is there are particularly the limited service properties. And I think the challenge that we see now is that there are so many prospective multifamily buyers that want to convert, that they have pushed up the prices so much that they hardly work out from a financial perspective anymore, right? So if you start paying $40,000 per unit for a tiny 325, 350 square foot studio, in a less desirable location, the upside is not really that strong anymore, right? So I think that's what we have seen. The initial phase was really attractive because people were able to pick up these properties at maybe 10,000, 12,000 per door. And now you have a lot of buyers that are willing to pay 40,000 plus.
Wow. What I always wondered on those, because we saw a few come across our desk, but I didn't understand how it was going to work just from a parking ratio perspective. So that was, because I had several clients asking like, hey, should we do this? Seems like an opportunity. I don't feel like we saw much distress in the hotel industry here in Dallas, Fort Worth. Houston got hit particularly hard. But Dallas Fort Worth seemed to weather that storm a little bit better. But yeah, I mean, I was just, I said, look, I don't see how you crack that code of like, we don't have enough parking to make this multifamily. And unless you're going to pick up some from maybe the retail center next door, because you're going to buy that too, I don't see how you crack this code.
Yeah, it's typically where we have seen where it works best is in not in a core market or top market like Dallas and Fort Worth. Even Houston is too dense, but it works well in the secondary and tertiary markets where there is the parking tends to be not such a big issue, and also where the cities are much more welcoming to such conversions.
Okay.
Yeah, I still do not see that they are actually working out from a financial perspective for some of these buyers, unless again they bought them at the 10,000, 12,000 per door, right?
Yeah.
So that
where it's like, I can't make a mistake at that price. You're buying it, well below replacement cost, the bricks and sticks.
Yeah, that's right. Yeah.
we've got an interesting project that we're bringing to market here in the next week or two. That is it was built in Las Colinas, the Irving submarket there, right off of Royal and George Bush, and by Hackberry Country Club, called Water Walk, and it is about 50% multifamily and 50% hotel, and largely one building that is the multifamily, except one floor on that one, and then the other one's pretty much run as a hotel. And that seems to work in terms of the parking ratios and that sort of thing. And it's a really unique asset, but the pricing's good on it at our whisper price. It's 153 units at a whisper price of 30 million. We see it as a 7.3 cap operating as is today.
Yeah.
So people come to us though, and as we did a coming soon, and at first we were saying, well, a lot of people are like, well, what if we converted all to multifamily? Because obviously you lower your cap rate multifamily, and that's the perceived, hey, I'm increasing the value. We've run the traps on it, and what makes the most sense, in my opinion, is just keep running it the way it is, because you will cut your income like virtually $1 million on this asset, take it multifamily, lower your cap rate, and at the end of the day, I don't think you're going to have as much value if you just get the natural appreciation from the multifamily and hotel side. So real unique asset though.
Yeah, that's is that operated under a major flag, or is it just?
Yeah, Water Walk is a flag.
Okay.
I don't know how major it is. I know there's one other in Richardson.
Okay.
It's real close to where I live, and I've seen it. It's like a very similar development. But it does take a hotel operator.
Right.
It's you're going to have to pay a hotel operator, and they love the multifamily side because that's easy peasy for them.
Sure, that's right. Yeah, absolutely. So they built that originally in that fashion?
Yes, they did. It is PD with the city of Irving, Las Colinas,
allowed
and they allow for that. Which I've sold a lot of different stuff over my tenure here as a broker, and hotel is something that I've barely dipped my toe in the water on. And the only reason that we'll sell any other type of asset type is one, to help a client of ours in a 1031, they're getting out of multifamily, or two, they're just a really good client and they said, hey, we want to list our office building with you, and I'm like, well, I don't really do that. They're like, we don't care, we're gonna all right. Sounds like an interesting idea, I'll do it, I guess. But that's what led me to different product types. But I don't know, I think it's kind of a neat deal, and I think there might be something to it. It was constructed in 2018, but we're seeing in East Dallas, for example, an incredible amount of VRBOs on some of those rent rolls. Like, it is financing prohibitive amount of Airbnbs on those rent rolls. And so when you think about it, like when you do, when people vacation now, they're not really looking for the bed next to the credenza in a bathroom,
That's right.
They want a little kitchenette, they want a little bit more space in there, and to have like a little living room area that they can work in and not just sit in the bed, hammering away on their laptop anymore. That's fallen out of favor, let's say. And so I just think, I'm like, they might be onto something here.
Mm-hmm. Very good point. Yeah. Todd, really appreciate your time. I think you've shared a lot of information here with our listeners. You have a unique insight into Dallas, and with your network, obviously with some others, and that was really valuable. John, do you have any other question or comments that you would like to point to?
No. Thanks, Todd, for the time. Appreciate it. Very insightful.
Thank you. Thank you so much for the opportunity.
Yeah. So Todd, how can our listeners reach out to you? Obviously, you're important to know, right? Whether you're a buyer in Dallas, Fort Worth, or you're a seller. Probably all sellers know you by now.
I would hope,
In
but
that market,
you
but
never know. You don't feel like you can touch everyone as much as you'd like.
yeah.
But we have a relatively large team here. There are 13 brokers, 7 support staff, so there's 20 of us. But if you want to reach out to me, I am. It's easy enough. My email address is my name, Todd TODD Franks FRANKS at Greystone ISG, and that's GREYSTONE ISG like Indigo Sam Green.com.
All right, great. So I encourage everyone to reach out to Todd. Right, he has a wealth of knowledge when it comes to Dallas multifamily, and it's only worthwhile to reach out to him. Thanks again, Todd, for your time, and good luck for the rest of 2021, and then another successful year in 2022.
Thank you. And again, so much appreciate the opportunity, and have a great rest of the year, and hopefully it keeps rolling into 2022.
Yeah, let's hope so. Thanks, Todd.
All right.
Thanks, Don.
Bye now. Thanks, John.